Welcome everybody to today's webinar presented by Dannible McKee. We're doing the top 10 financial and tax planning tips. We're heading into fall, getting towards colder months, and we on the tax and accounting side like to start things. Contractors out there should be thinking about and doing as we head towards the end of the year. This is, I believe, number 6 of 11 webinars Dannible McKee is doing in a series throughout the summer, and I believe there's a handful more coming up. And we also will be having an in-person conference on November 6th regarding tax and financial planning that will be held in Syracuse, New York. So keep your eyes open for that. But just want to kind of point that out to everybody as we get started here. My name is Ben Sumner. I'm an audit partner with Dannible McKee. Been at the firm for 14, 15 years now, and really focus on financial reporting with construction industry being one of my main focus industry areas.
Yep, and I'm Shawn Layo. I'm a tax partner at Dannible McKee. I've been with the firm for just over 23 years now. And my focus is obviously with heavy in the tax planning, and like Ben, one of the industry specializations that I have is with contractors.
So the way the webinar is going to be set up is, I'm going to be handling kind of the financial and kind of the corporate side of running the accounting for the business and some tips and tricks, and then we'll be kind of flipping back and forth. I'll do a set, and then Shawn will go in and handle a tax topic, and then I'll pop back in to some more financial areas. So to start out, and that's us there on screen. Hello. Number 1 tip on the financial side and kind of corporate side is to review your insurance and banking needs as you're kind of coming out through the year and coming up towards year end. Look at your insurance coverage limits that you have out there. Do you have enough? Have you had any major changes in your operations or in your revenue levels and the head count that you have for employees? Does the insurance that you currently have, is it enough? And hopefully you have good relationships with your insurance agents, but where are your premiums sitting on the spectrum? Have you shopped around at all and looking at what else is available out there? What about any new large equipment? Have you bought any new large equipment this year? Are we sure that everything in our stock is covered by insurance? Hopefully you're already on top of that, but never hurts to take an extra look at that. Third bullet point down, looking at cyber and fraud insurance coverage. This is a real hot topic area. I've had several clients in the last few years that have had cyber attacks happen, incredibly costly. And for a couple of them, they didn't have sufficient cyber insurance in place. And they really took a major financial hit from that. A lot of times in the construction industry, the thought process is, oh, we don't use that much in the system. What are they going to get to? But nobody is immune from these attacks. So talking to your agents out there about, what do I have and what do I really need? And never think that you're safe from these attacks. And at the same time, looking at your internal policies and procedures surrounding cyber protection, are you having network penetration tests done on a regular basis? What are your internal controls surrounding IT? Have you looked at those? Because that is a big part. If you do have a cyber policy, they're going to require some of that. But making sure that you're looking at that up front, really can't stress enough how important it is to look at those types of insurance. Also on the insurance side, looking at kind of when you go through general liability and workers' comp and you're going through your renewals, you have to set an estimate of where you think your payroll and your sales and revenue levels are going to be at the beginning of the year. Are you keeping track of that as you're coming towards the end of your policy periods? Do you know where you're really sitting, and is there potential that you're going to owe some money on workers' comp and general liability audits at the end of the policy period. Taking an extra look at that and making sure you're really on top of it before, you know, it's too late and you end up getting stuck with a big bill at the end. Just kind of making sure that you're paying attention to those as the year's progressing. And the last bullet point on the slide, just consider any other new types of insurance that might be out there that, you know, maybe you didn't even know about, or you know, could provide you with some additional protection just in case. Just some points in there, you know, subcontractor insurance, pollution insurance, or errors and omissions. You know, being the nature of the construction industry is so contract driven and so contract heavy, that errors and omissions and professional liability coverage may really benefit you just in case. Whoops, skipped one. And then looking at your banking relationships and where do you sit from a banking perspective? Are all your eggs in one basket? What I'm referring to there is all your cash sitting in one bank, in one account? Is it, you keep in mind FDIC protects you up to 250,000 per deposit agency, so per bank, right? If you have excess cash holdings, some of that may be at risk. So taking a look at that, you know, this year, when you were going through everything last year, keeping an eye on it, you may be in a different cash position right now. So something to consider. Looking at your line of credit with the bank, has the availability been the same for the last 20 years, and the company's in a different position now, and potentially, you know, you see the opportunity to increase that availability. And I also want to point out too, regarding line of credit, if you have a line of credit or if you have any term notes with the bank and there's debt covenants on those, take another look at your debt covenants. A lot of them have debt service coverage ratios or current ratio requirements. Do the numbers that are in there still make sense? Is it still the same ratio that you've been trying to hit for 20 years? And is your company, is it effectively the same as it was 20 years ago? And I would say probably not. Or if you find that every year you're having to go to the bank and request a waiver because you can't hit that ratio, then you might want to take another look at that and meet with your banker and go, something's not right here. Let's take another look at that. Looking at fraud protections, you know, we meet monthly as a partner group at Dannible McKee, and you know, we have certain fraud protections in place, but our managing partner noted that, you know, our banker told us, yeah, people are trying to get in all the time. Luckily, the fraud protections keep you safe. You know, positive pay is the big one. Making sure that you have your money protected is incredibly important. And as I mentioned on the last slide with cyber insurance, that's nobody's safe from it, individually and businesses especially. Also talk about and look into some cash management services, ACH payments, remote deposits. If you're not using those already, it can really save you time and make kind of running your business a little more efficient. And then the last point on the slide here, interest rate management. So looking at strategies to manage your interest rate risks, things have been kind of all over the place, especially since the pandemic hit, and then we saw inflation and where the interest rates have gone. You know, there's probably some ways to manage that. If you have excess cash, are you utilizing overnight sweeps where you can earn, you know, 4 or 5+% on those deposits, which can help to offset some of the higher interest rates on your variable rate debt you might have out there. So taking a look at all those things can really help benefit you as we head to the end of the year. You know, this is a great time to start looking at that. Pass it over to Shawn here for point 2.
Thanks, Ben. So as Ben mentioned, we're going to kind of alternate financial points and tax points. I'm going to cover some credits and tax methods that can hopefully, you know, ensure that you save some taxes coming up here for 2024 as we approach year end. The first credit I'm going to cover is research and development tax credit. R&D tax credits, government incentive designed to reward companies for investing in innovation. It's been around a long time. It started back in 1981, and it became permanent as part of the federal tax code in 2015. It's under code section 41 and the related regulations. They're pretty detailed. We're obviously not going to cover every single thing that's in the code and regulations. That would take probably a full day to cover. So we're going to go through some of the basics here. And some of the benefits, you can receive up to 12 to 16 cents per dollar of R&D tax credit for every qualified dollar spent. It's a dollar for dollar reduction in your federal and state income tax liability since it is a credit. It can reduce your overall effective tax rate. It can improve your tax flow because you're saving money that you would otherwise spend on taxes and paying governments. And the credit, if it's unused in the current year, can be carried forward up to 20 years. There is a 4-part test that you need to go through to see if you would in fact qualify for the R&D credit. The first test is the elimination of uncertainty. And that's basically is the activity being performed to eliminate technical uncertainty about the development or improvement of a product or process. And it generally includes computer software, techniques, formulas, and inventions. The second part is the process of experimentation, which involves, an evaluation of alternative solutions or approaches. And it's performed through modeling, simulation, systematic trial and error, other methods similar to that. Part 3 is it technological in nature. So is it involving engineering, physics, chemistry, biology, or computer science? And the fourth is the permitted purpose. Is the purpose of the activity to create a new or improved product or process that results in increased performance, function, reliability, or quality?
And all 4 parts have to be met, correct?
All 4 parts have to be met in order for something to be qualified as an R&D activity. For contractors, here's some qualifying activities: developing new or improved products, processes, or techniques, developing prototypes or models, developing green methods, sustainable technology, developing unique assembly or construction methods and processes, experimentation with new building materials, identifying technological improvements in construction processes or to the products and softwares used.
I mean, I'd like to think that a lot of the contractors out there would qualify, at least would have some sort of activity that would kind of meet one of those.
And coming up, we'll go through some of those areas you'd want to look to see if you are in fact incurring any R&D expenses. Development or adaptation of tools, equipment, or other materials to improve efficiency, or adaptation of construction techniques, adapting equipment or processes to meet new regulatory requirements, which can include innovative scaffolding or safe working processes, which is becoming more and more, important in today's environment. Design and development of new mechanical and electrical systems. And then any project that required an extra level of testing or certification upon completion. Some activities that are excluded would be anything conducted outside the US. They obviously want to keep it in-house. Adaptation or duplication of an existing business component. So you can't just replicate something you're already doing and say, hey, this is R&D. Market research, testing or development. Routine data collection, routine testing or inspection for quality control, survey studies relating to management function, research related to social sciences, arts, or humanities. And one of the most important ones, which would, if you did actually file for an R&D credit that would get denied right away, is if the research is funded by any grant or contract. And what that means is, are you at risk for the expenses that you're incurring, or are they going to be completely covered? Is somebody going to pay you regardless of whether or not the R&D was effective and actually was successful? And if that's the case, they're going to disallow it and say that it's not specific R&D. So you have to be on the hook for some sort of amount of risk where you have the potential to lose some money if in fact it's not successful.
Yeah, on the hook, meaning you're going to be spending money on
Yeah,
it.
exactly. You're
Yeah.
incurring it and are not gonna be reimbursed for it by the customer or government entity that you're performing it for. The expenses that can be claimed, to get the R&D expense and credit. Wages, so you have to go through and look at all your employees and determine who's working on an R&D project. And those would include engineering, design, or design build projects. And they don't have to spend 100% of their time on that R&D project. You have to go through and do a detailed analysis and determine how much of their time is spent on these R&D projects. So it could be one employee works 20% on an R&D project, another works 40%. Whatever that percentage happens to be, you would multiply by their overall gross wages, and that would be the amount that you can claim as a qualified research expense.
And as the auditor likes documentation, I would urge, if you are thinking about going after some R&D credits, or you think that you qualify and you're going to have R&D expenses, document.
Yeah.
Right, keep sufficient documentation. If you can break that out in the payroll registers, that this person was working on project XYZ, that's dedicated for R&D, have them code their time to that in their timesheets and code it that way in payroll. And then it's airtight and it really can't be, it can't be looked at and denied by the IRS.
Right, and to Ben's point with documentation, for each project, you're gonna wanna go through and make sure that it doesn't qualify for that, meet that 4-part test that we talked about previously. So you're gonna wanna have some sort of documentation as to each component of that 4-part test and why you feel that project meets those requirements. And documentation is going to become even more important with the R&D credit. The form 6765, which is what you actually file with the tax return, starting in 24 is now gonna have some additional reporting requirements where you have to list, any owner's wages that are being included. You have to list the number of projects that you're saying make up this credit.
Sure.
And then in 2025, they're gonna be adding even more. So it's essentially a way that the IRS, when you file your tax return, is gonna audit the R&D right there rather than open up a separate audit. They're gonna take a look at it right away and determine whether or not they feel you qualify for this.
Right on the face of the return.
Other expenses that are qualified research expenses are raw materials and supplies used and consumed in the R&D process. Any of those you get to include 100%. And I should note, going back to wages for one brief second, I had mentioned the percentage of time that each employee spends on the project. If an employee spends 80% or more of their time on a project, you actually get to include 100% of their wages.
Considered the 100% of their time.
It's the definition of substantially all.
Gotcha.
In the IRS's mind. So 80% or more, you get to include 100% of the wages as qualified research expenses. Anything less than 80% is just that percentage times that employee's gross wages. The third bullet point, and I'm not gonna go into too much on the fourth bullet point, but the third one is contract research expenses. So if you hire a third party and they perform qualified research activities on your behalf, then regardless of whether they're successful in their research or not, you're allowed 65% of that cost. So, $1,000 that you pay to a third party, $650 of it would be includable as a qualified research expense. Companies are now required to amortize their R&D costs over 5 years. So while the tax credit is a permanent thing, you're gonna generate the credit, you're no longer able to deduct your R&D expenses
Immediately.
on the financial
Right.
statement side. They're now required to be capitalized and amortized over 60 months. In the past, you were able to, and there's an example coming up, but I'll just go into it now. If you had $100,000 of R&D expenses incurred during the year, this was prior to 2022, you would have been able to expense that $100,000 on your financial statement P&L and also obtain it as a deduction for tax purposes. Now what they're requiring you to do is capitalize that $100,000 and amortize it over 60 months.
For tax
So,
only though.
yeah, for tax only.
You still will expense it in your financial statements and from
Yeah.
an internal perspective.
Yeah, but for tax, you have to add that expense back and take it over 60 months. The other kicker is that in year one, they only give you a half a year. So there's, no matter when you incurred that expense, the IRS is gonna treat it as though it's incurred on July 1st. So in essence, over a 5-year period, you're only getting to expense 10% of those R&D costs in year one.
Yeah, and I know a lot of clients, when this hit last year, 23, correct?
Yeah.
Was the first year that was effective.
22.
22, thank you.
Yep.
A lot of our clients were saying, well, then I just didn't have any R&D expenses this year.
Right.
But the issue there is you're missing out on the credit still.
Because the
which
credit
is
is
a
a
dollar
permanent
for
thing.
dollar tax credit against your tax that you owe. You lose that, but on the other side, you're just deferring the tax deduction. So you're still gonna get the
Yeah.
R&D deductions. It's just gonna
Yep.
take 5 years instead of immediate.
Exactly. So for tax years after 2022, there is a payroll tax research credit that some of you may be aware of. But after 2022, it's essentially for startup companies. So anyone in their first 5 years of operations, you can choose to apply the credit against payroll tax instead of income tax. You can have had more than $5 million in revenues in the current year. And again, you have to be within your first 5 years of operation. So it's really for small businesses and startup companies. But I thought it was important to point out that this is available and a potential to take it off payroll taxes instead of income taxes. And as I previously mentioned, there's newly revised drafts of the Form 6765, which is what you claim the R&D credit on. That requires additional qualitative and quantitative information regarding the company itself and each business component generating the credit. And again, 2024 starts off a little slow with this, but 2025, it really picks up. And much of the newly required information, hopefully, as Ben said, document.
Yeah, keep it.
Hopefully, it's already in your records and it doesn't become too much of an additional burden when it comes time to file taxes, if you are in fact going to apply for the R&D credit. This was just the example that I talked about before, where you previously could expense $100,000. So this is a C corporation example. Say the R&D credit was $5,530. The tax rate's 21%. So you also generated $21,000 of an expense off of that $100,000. Or tax savings, I should say, off of the $100,000 of expense. So previously you'd get a $26,000 tax savings in year one. Well, now where you have to amortize and capitalize the R&D expenses, that same 100,000, assume the same R&D tax credit, because the tax rate is 21%, 100,000 times 21% is 21,000. You're only getting a 10% benefit for those expenses in year one. That's where that 2,100 in tax savings is coming up with. So where you used to get 26,000, now you're more in the $7,600 range.
Yeah,
so
big deal. That's a lot of money.
But it is a timing difference. It reverses over time. It's just the initial impact is pretty severe. Will future legislation changes?
Hopefully it'll change.
Hopefully, we don't have a solid answer yet, but hopefully in 2025, something will be rectified so that these expenses no longer need to be amortized and can instead be deducted like they used to be in year one.
I mean, the whole idea is with R&D is the government's trying to incentivize innovation. And by requiring the add back, I think that it's hurting that, American innovation that we're known for, so.
Correct.
Okay, so moving on to point 3, evaluate your strategic plan. This is really on a high level. So how are you operating the business as a whole? And this will really be looking and coming down from the ownership, high level managers, project managers. How are you looking at the strategy for the business as a whole? Are you looking at market research and and trends and where the economy is going? Or are you kind of just saying, I've been in this location, I've been doing the same work for the last, 50 years. This company's been doing the same work for 50 years and we're good where we're at. Or are you looking to expand? Are you looking to move into new geographic locations? Do you know that there's going to be significant economic changes in the area coming up that you need to plan for? Are you looking at potential risks and uncertainties? Are you looking at interest rate risk? Are you looking at where the overall economy is going? Are you looking at where the federal government and the state governments are spending money and looking at the trends in private construction? What's happening in your area and where do you want to go? And then quantifying the financial impact of that strategic plan. So this would be known as kind of a high level budgeting. So first deciding what's our strategy as a business as a whole, where do we want to be, where are we now? And then building that into a financial model in a financial statement, from a financial statement perspective, and looking at your revenue forecasts, and looking at expense changes, interest rates or wage inflation, how that's hurting you, how are we projecting that into our financial models? So going through a budgeting process overall, and then obtaining commitment to achieve those financial goals. This is really where it's coming down from the upper level management and ownership. You can pass down what our strategic plan is and set a budget, but if it's not attainable and if it's not measurable, then it's no good to anybody. So at the end of the day, you need to say, well, we're going to be pushing our strategic plan down to project managers and management and other workers in the field that we need to be more efficient, or we're going to move into this geographic location, or we're going to try to get into this other type of construction. How are you going to measure whether it's successful or not? And really that's a matter of looking at what that is and defining the key performance indicators, KPIs, which I'm going to be talking about in the construction realm a little bit later on in this presentation. And then once you've determined that, then going through the process of evaluating success or failure. So kind of this section of the presentation is looking at the business as a whole. From the last slide, look at the strategic plan. Where are we? Where do we want to go? What are the opportunities? What are the risks to us? Second step, look at the budget, putting it into financial data, determining what the most relevant performance indicators are, and communicating those and utilizing those to measure whether we attained our plan or not. And this isn't necessarily something that's you set it and forget it. It's something that you need to look at, and it needs to adapt to your business. And it's something that it should be a longer term plan, not necessary. And you can do it on a short term. Hey, we're heading into summer season. It's heavy construction season. We're out there, at least in New York. There's not a lot you can do in the winter. In certain construction sectors, obviously, but not doing a ton of road construction in the middle of February. So, you're going out into the summer. Here's what we're shooting for this season, but then taking a step back and looking at the business overall. Where are we? Where do we see things going? Where do we want to be? Set that up, set projections in place, and then set how you're going to determine how well we're performing against those metrics. And then, review where you're at and reflect on that information. It sounds, a little bit, in construction, everything's really hard and concrete and you like solid numbers, but it's more of a soft skill type of process, I think. But really taking that top down look at the business as a whole, sometimes it's easy to get kind of into the details, but kind of my suggestion is to take a step back, look at the business as a whole, and look at the industry and kind of where things are at and move from there. Shawn?
All right, work opportunity tax credit. So this is the most often overlooked credit in the construction arena and other industries, quite honestly. But it's a federal tax credit available to employers who invest in American job seekers who have consistently faced barriers to employment. And right now, under the Consolidated Appropriations Act it's been extended through December 31st, 2025. So you still got 2 more years for this. It's a credit for employers who hire and pay wages to individuals who are a member of one of 10 targeted groups. There's a slide on those targeted groups coming up. And for those that are in the 10 targeted groups, they have to perform at least 120 hours of service during their first or second year of employment. It's a pretty good credit. The credit's equal to 40% of 6,000 qualified wages, which is $2,400. This is if they work over 400 hours during the year, or 25% of $6,000 in wages for a $1,500 credit for those that are in between 120 and 400 hours worked. Qualified veterans, if you meet certain requirements, you can actually use up to 24,000 of their wages, which would generate a $9,600 credit. And the important thing to know here is if you use somebody's wages, one of the employees' wages for their work opportunity tax credit, you can't use those same wages to qualify for the R&D.
Yeah, you'd have to pull those out.
Yes,
right?
exactly.
Yeah.
So you can't double up, in other words. And here's a listing of the targeted groups. The main ones that we see are qualified veterans. Sometimes we've seen ex-felons, and then SSI recipients. So if somebody's already receiving Social Security benefits and you hire them, they would potentially qualify for this work opportunity tax credit. What we would suggest is when you hire somebody new and they get their packet for coming in, they're filling out their tax withholding forms, they're given a job description, whatever your new hire packet includes, we would suggest putting IRS form 8850 in that packet. This makes it so you don't have to specifically ask that employee, hey, do you fall into one of these areas? If you just include this in their opening packet, they fill it out on page 1. If they check one of the boxes that they do in fact qualify as a member under one of those targeted groups, you would fill out page 2 of that form and then submit it to the state workforce agency. The important thing is that has to be done within 28 days after they begin work. So that's why the form 8850 really should be included in the packet for all new hires that you have.
Does the form include the different classes or different, so
And it would have a box that they would check.
kind of could be hey, are you an ex-felon? It could be weird to ask the question. Hopefully you know
Yes,
that
it doesn't put you on the spot.
However, if you, give it to them and go, let us know if any of these apply to you.
Yep.
And then, hey, you could earn some work opportunity tax credits for it.
Because once you, provide the state workforce agency with that form 8850, within 28 days again, they'll respond to you that employee is certified, and that's how you generate the tax credit. Here's an example. I'm not going to go through in great detail in the essence of time, but there are 3 employees here, and you will get a copy of all of our presentations and actually a copy of the webinar itself as well. So you can go back and refer to this example, but 3 employees varying, one works under 100 or under 400 hours. One's a qualified veteran with service connected disability. Another's a qualified veteran. Hey, for 3 employees, there's a $12,750 tax credit that was generated in this example. So that's again, a dollar for dollar reduction of your overall tax. So it's a pretty good benefit to have. And with that, I will turn it back over to Ben.
Thanks, Shawn. Tip number 5. This may seem obvious to construction. Anybody in the accounting construction world, probably seems obvious, but you would be very surprised we have seen new clients come in, don't even know what we're talking about when we talk about performing a contract review and going through looking at the contracts themselves. So I do want to I did want to add a point here about performing a contract review. So especially if you are a 1231 financial reporting taxpayer, all the above, your year end is 1231. We are at September 19th today. So we've got just over 3 months left in the year. You probably should be looking at where your contracts stand. How did they, take a look at, where did we end up billing and how much did the contract end up costing us compared to budget? That would be the very bare minimum, or we'll even take the budget piece out. How did this particular contract do? How much did we bill and what were our costs? Even taking that level is step one. Beyond that, I would hope you have some budgeting process on a contract by contract basis. Especially if it's a bid type contract, that the bid was your starting budget for your cost. That's just kind of, we had a cost determined. We determined the price we were gonna charge based on the costs. We kind of already should have that information, but then how are we going through the process and reviewing all that after the fact? And then investigating discrepancies, and what does it say again? Maintain adequate documentation for major changes from budgeted amounts. Again, it may seem silly or obvious to some of you to go through a contract after the fact, and even during, we should be reviewing throughout the contract life cycle, especially if it's a multi-year contract. But even for something that's generally started and completed in the same year, we know what we should be aiming for. Are we looking at where did it end up? And then are we keeping track of why did it not end up where we thought it was going to? And a lot of that can benefit you in a couple different ways. It can identify if was there a change order we should go after because it was outside of our control? Do we have a problem with the project manager? You're not gonna know that if you don't go through the process. And also taking a look at costs and how do we know that the costs are accurate? Have we looked at the overhead? Are we bringing overhead into the contract? GAAP reporting, from my perspective, on a financial statement basis requires that you apply overhead. What is overhead? How are we applying it? What are the methods we're using? Taking a look at what overhead was applied to the contract, if any, and how did that impact the contracts? Number two in this area, prepare a WIP schedule. Once you've got your data, we should really be looking at all of that in a very formalized, we like spreadsheets because we're accountants, but some form of method of reviewing all of your contracts in one place. We call them work in process WIP schedules. Hopefully you've all heard of it out there. They're going to show all your active and completed jobs during the reporting period. They're going to show completed jobs where they landed. They're going to show active jobs where we think they're going to land and where they are currently. The key components, really there's four. If you want to put a WIP schedule together, there's four pieces of data that you need. You need the total contract amount. What was the bid? It's $4 million contract. Okay, 4 million is your contract amount. How much cost have we incurred so far? That's number two. How much cost do we think we're going to incur for the remaining portion of the contract? That's number three. And how much have we billed to date on the contract? That's number four. Those four pieces of data are really all you need to put together a contract schedule. However, as I'll talk about in my next section up, the data that you're getting has to be accurate and has to be segregated properly in order for that to happen. So what does a WIP schedule look like? Well, this is a very basic, Dannible McKee kind of has our way of doing it. I've looked at a bunch of different financial statements out there. Different firms do it differently. Different companies do it a little bit differently. But at the end of the day, the data that's in these schedules should all kind of be the same. Like I mentioned, 4 different key parts. What's the contract price? What's our costs? How much do we expect we're gonna spend to complete this contract for the rest of the contract? Like, how much have we billed to date? And you can come up with a contract schedule. Once you have this contract schedule in place, it gives you the ability to perform some more detailed evaluation. It gives you a much bigger picture. Look at how did this contract do? How did this contract? What's our profit on this one? Oh, this one didn't do so well. What happened? And again, I have in a further slides later on, I have some ways you can use these schedules to evaluate overall performance. Also, as part of your contract review, as I mentioned, one of the 4 parts of that you need to put a WIP schedule together is estimates. Let's take a look at our estimates. Accurate estimating is just about the most important thing for you to run your construction business effectively and efficiently. and keep your profitability up. Because I've seen it happen. Hear me out. I have seen it happen where you have poor, company has poor estimating. They think they're gonna do better on a job than they actually do. Their cash flow gets choked and they're scraping a year later. It can happen really, really quickly in the construction industry. One bad job, one bad estimate can mean the difference between your company surviving and not. And as I mentioned, as it says in the third bullet point down, you know, poor billing practices and poor cash management. Take a look at the overbillings and underbillings. If your revenue that you've recognized is less than the amount that you've billed, then you're overbilled. On your financial statements, that's a liability. Why is it a liability? Because it's work we have to do in the future that we've already been paid for. So you got to keep that in mind, keep an eye on those things. And then using that WIP schedule to look at project gain and fade. It's a really great analysis as well, because you're looking at, you know, we had a contract, we thought it was gonna have 10% profit margin. We're getting out to towards the end. It's at 5. Well, what happened? Let's analyze it, let's document it, and then we can take that into consideration in the future. Shawn?
Pass-through entity tax. New York State implemented this program back in 2021. And essentially it allows any pass-through entities, which are partnerships and or S corporations, to pay tax on the entity's taxable income on behalf of its shareholders or members. So whatever the taxable income of that pass-through entity is, the S corp or partnership, they would pay, and there's tax rates that begin at 6.85% and work their way up to 10.9%. They pay the tax, there gets a federal deduction for that tax payment, and the individual members or shareholders obtain a tax credit that is passed through to them for the amount of PTET paid. Why this is important is because of the Tax Cuts and Jobs Act. There was a SALT cap limit that I'm sure many of you are familiar with, where on your personal return, many of you don't itemize deductions anymore. The reason being is state and local income taxes are limited to $10,000
Of deduction.
of a deduction.
Right.
This is a workaround to that. So these are taxes, again, the income from the S corp or partnership is passed through to you and reported on your personal tax return. These are taxes that you would have otherwise had to pay to New York State yourself, but you would have obtained no benefit for them, no tax deduction. By allowing the entity itself to cover the taxes on your behalf for whatever that entity's taxable income is, it allows a federal deduction that you would have otherwise lost.
With no cash flow change, really.
Exactly.
The amount of cash paid is the same. You're just getting additional deductions that pass through. You're passing less taxable income through on your personal return.
Exactly, and that's because typically a pass-through entity is going to make distributions to cover the owner's taxes. And so this way, you're just paying the taxes instead of putting it through distributions, but you're retaining an expense for it. Again, it's eligible partnerships and S corporations.
Pretty
C
much all of them.
corporations, unfortunately, not eligible. They're not a pass-through entity, number one, and C corporations are already allowed to deduct state income taxes, so. Doesn't count. An annual election needs to be made each year, and it has to be made by March 15th of that year. So for 2024, the date is already passed. It was March 15th of 24. So essentially 2.5 months after the beginning of a new tax year is when this election is due. The election is irrevocable. It requires that estimated tax payments are made during the year, and the estimated tax payments, similar to personal estimated tax payments, they're quarterly. In this case, they're March 15th, June 15th, September 15th, December 15th. And you have to base them either on 90% of the current year anticipated tax or 100% of the prior year tax to avoid incurring any interest. There is an annual PTET return filing requirement. Similar to your S corp or partnership return, you are allowed a 6-month extension of time. So from March 15th, you can extend and then file by September 15th, which happened this past week.
Yep.
And you do have to file the return whether or not you had income or
That's
almost.
it's a major savings to owners of
It's
partnerships
huge.
and S corps.
And in this quick example, again, I'm not gonna go through the example, just look at the bottom line. So on 1.2 million of income at a 6.85% tax rate, the credit and deduction generated is 82,200. The 82,200 is spread throughout all of the owners or shareholders based on their ownership percentage. But then the asterisk at the bottom, the note. So the shareholders receive a combined federal income tax deduction of 82,200. Assuming they're in a 32% tax bracket, they recognize federal income tax savings of approximately $26,000.
Across all three.
If the entity did not pay this tax and the individuals conversely paid the tax like used to be practiced, pre-2021, instead of a $26,000 deduction, you would have been capped at 10,000 ultimately. And it just, this provides a major benefit in obtaining a deduction that was taken away by the Tax Cuts and Jobs Act. Keep in mind to look through, if you file in multiple states, there are 35 other states that have a pass-through entity tax. Some are automatic elections, some you have to elect with the return. There's all different ways, but just consult with your CPA and figure out if you do in fact qualify for any of these other state PTET taxes.
And every state's different.
Every state is different.
So yeah,
Can't follow New York. It's each state has their own.
I'm glad I don't have to
ways
keep
and
it
means.
straight. That's you tax partners and tax guys out there are at a disadvantage there. All right, number 7, enhance your financial statement analysis. We talked about, overall looking at banking insurance. On the financial side, we talked about looking at the strategic plan. We looked at contract review on an individual basis, but really from an accounting perspective, we want to look at our whole financial statements and perform some analysis. The first piece is how good is the reporting out of your accounting software? So I mentioned that earlier, the data coming out and going in has got to be good in order for you to make good decisions. So just some questions in the bullet points. How often is management actually looking at internal state financials? Is this done is management looking at, asking accounting for a financial statement on a monthly basis? Are they only looking at it, twice a year? Are they never looking at it? I would highly recommend at least once a month. I mean, quarterly would be probably a stretch. How accurate is the accounting data coming out? Are you confident that what's going in and coming out is right? Have you performed some checks and balances there? How detailed, if you are looking at internal financials and running them, how detailed are they? Are they providing you with adequate information? Or is it just one line assets, one line liabilities, and that's it? Or are you breaking it down into further detail? However, you may not need it on a trial balance level where it's every single account showing up in your financial. You want to lump those in and group them into effective, similar if you have an external financial, like what Dannible McKee would review or audit. Cash, accounts receivable, inventory, lump those accounts into more relevant data areas. Is a statement of cash flows being prepared regularly? I mean, the cash is king in the construction world. So think about, are you looking at where the cash is coming from and going? You can look at your bank account, but that doesn't tell you the story. Cash flow statement's my favorite to look at because it tells you if you're generating cash, what are you doing with the cash you're generating? Is the operation generating 500,000, but we're paying 500,000 out in debt every year? You're making money, but the bank account's not showing it. Well, that's why. And are you properly segregating in an effective manner for how the business should be segregated? Can you segregate your financial reporting by division, location, or by project manager? Then once we have appropriate data in a financial statement format, are we doing a fluctuation analysis? Are we looking at how do we do this month versus last month? How do we do this year versus last year? Are we looking at the reasons for those? Are we looking at allocations of costs? Are we looking at things that are in selling general and administrative expenses that probably should be allocated as costs to the contracts? Taking a step back again and looking at the data and taking a higher level look at it. What are some things that we should be doing? Overhead's a big piece of it. Especially in the construction world, not knowing your costs can really hurt you. And then are we performing a budget to actual comparison? Did we do a budget? Was there a budget in the first place? I hope so.
Hopefully there was.
But I'll tell you what, I see a lot of companies out there that aren't going through a budgeting process. It's really hard to tell how you're doing and whether you're meeting your goals without budgeting and comparing to budget. And if you are off, explaining why and performing that analysis and documenting the reasons so you can keep track over time. Where are our costs trending? Where's, do we have this group, team A, team B, team C? Do we have enough data to look at, hey, team C, you're really struggling, or hey, you've been really improving over time? Hard to tell and do that without having accurate financial information, having it in the right format, and then performing some sort of analysis and reflection on that. Shawn?
Tax accounting methods for contractors. So everybody's probably familiar with percentage of completion for long-term contracts. For federal income taxes, there's 2 exceptions, and that's a home construction contract or a small contractor exemption. The home construction contract is any contract where 80% or more of the estimated total costs are reasonably attributable to the building. Construction, reconstruction of dwelling units contained in buildings with 4 or fewer dwelling units. Any contractor meeting the home construction contract exemption does not have to use percentage of completion for tax purposes. Small contractor exemption, it's basically it's a look back test. So it takes the prior 3-year averages of your gross receipts. If you're under $30 million for that 3-year average, you meet the test and therefore are exempt from using percentage of completion method. The definitions, just long-term contract. It's important to note it's any contract that spans 2 tax years. It could begin on December 31st and on January 2nd the next year. It could be a 3-day contract and be qualified as a long-term contract.
I'll tell you this much, when we do, we do a financial statement, we have our tax team come in and look at everything. From a tax perspective, I've been doing this a long time and I still have to kick it back to these guys for all the different tax methods for contractors that are available out there. So don't just assume the way you're doing it's the only way. There's probably some advantages you could get from taking a closer look.
Yeah, and here's several methods: percentage of completion, completed contract, and accrual less retainage. These are all for long-term contracts. Percentage of completion, not going to go into there.
That's what we do.
Completed contract method is essentially you can defer recognizing any profit from a tax return standpoint until the contract is at least 95% complete and the customer is using it for its intended purpose. This applies to small contractors. So again, if your prior 3-year average is under $30 million, essentially until that contract is 95% or more complete, you don't have to recognize the profit on those contracts for tax purposes.
On the profit.
Accrual less retention method. Retainage, it's not going to go into the definition of retainage. I'm sure you're all familiar with that. But essentially, you can establish a method of accounting to exclude retainage receivables and payables from accrual basis income until the cash is received and or paid. Large contractors, those over $30 million, aren't going to be able to apply the full accrual less retainage method. It's only going to apply to those that are short-term contracts.
Okay.
Those that are started and completed during the same year. Accrual less retention, here's 4 contracts. You'll see one of them is long-term, 3 of them are short-term. Total uncollected retainages are $21,000. A small taxpayer using the accrual less retainage could exclude $21,000 from their tax return.
Yep.
Large contractor would have to exclude the long-term contract. It's only available for short-term contracts. If you're a large contractor, it would be a $16,000 exclusion. 10% elective deferral, that's important to note. You don't have to recognize profit on the tax return side of things until a contract has reached 10% completion. Non-long-term contract deferral, contractors can defer the over or under billings related to short-term contracts That's again, a whip schedule that's,
Yep,
it's very important, not only from a financial standpoint, but from a tax standpoint. So any identified short-term contracts started and completed during the same year, the under or over billings need to be analyzed from a tax return standpoint, as there may be some deferrals. I'm gonna skip through the cash and accrual basis methods. They're pretty self-explanatory. I'm gonna turn it over to Ben in the
Perfect.
essence of time.
so the last piece that I wanted to talk about was just, we talked through the whole process, then you have the contracts, this is from a financial reporting perspective. You look at your contracts, then you get that data and the data goes up into the financial statement, you got the financial statements and we talked about analyzing it, how are we gonna analyze it? Well, I wanna talk just quickly about a couple of key performance indicators for construction, specifically. And the numbers and the targets are gonna vary based on the sector of construction you're in and just the nature of your business itself, but much like we talked about earlier with hitting your debt covenant, you should set some metrics that you're trying to reach and budget goals for certain performance indicators. So there's really 4 different types. There's a profitability type, there's liquidity type, there's leverage type, and efficiency type ratios. I have some examples of profitability, liquidity, leverage ratios, and efficiency ratios on the screen here. The biggest one that's underlined is working capital. Working capital for construction is the most important thing you should be looking at, and it's probably the easiest thing if you have accurate and relevant financial statements prepared on a regular basis. This is what the banks are gonna look at, this is what the bonding companies are gonna look at, this is what your accountants are gonna look at as far as, can you meet your current obligations as they become due? Do your current assets exceed your current liabilities? That's working capital, that's the key. And the third slide of my section, the last slide for me of the day, is some general construction industry standards. I think this is great as a starting point for benchmarking, and I wanted to provide this to everybody out there in webinar world. So, working capital, 10 to 15% of annual revenue. Debt to equity ratio, again, these are general, just things to look at. Debt to equity below 3 to 1. Under billings, less than 25% of working capital. So is working capital as a high number, but is it because our under billings are sufficiently high? Well, that means we've done the work, recognized revenue on the books, but we haven't been able to bill it to the customer yet. So bonding agents are gonna get a little scared about that. Cash to over billings, greater than 1-to-1 ratio. I talked about this earlier. If you have an overbilling, it means you've collected the cash, but you have future work to do on the project. They want to see that you haven't spent that cash on other stuff. The profit fade, we talked about that earlier, less than 10% of the original estimate. And then looking at the bonding capacity is generally going to roll somewhere in 10 to 20 times working capital. Again, your own scenario may vary from that, or 10 times net worth. Those are kind of general ratios. And for the last section, I'm going to kick it off to Shawn.
And we're gonna briefly talk about the new energy efficient home credit for contractors, also known as the Section 45L credit. This was previously expired, but got brought back into play by the Inflation Reduction Act of 22, and is now in play for homes, energy efficient homes acquired in 2023 through 2032. To qualify, eligible contractors must construct or substantially construct a qualified new energy efficient home. The home must be acquired by purchase or lease from the eligible contractor by a person for use as their primary residence.
So it doesn't apply to commercial buildings.
Yes.
Yeah.
An eligible contractor, it's any person or company that constructs the qualified home, but also the important thing is the contractor must own and have basis in the home during its construction to qualify.
Interesting.
So if the contractor doesn't own or have basis in the home, there's not going to be any credit generated. To qualify, the home must be located in the US. It must meet certain energy saving requirements as defined in the Internal Revenue Code section. There's different energy saving requirements based on the type of home. Single family homes, single family manufactured homes, multifamily homes. I'll let you do the research on that. I don't know all the requirements.
Yeah, we don't have a ton of them. I think we only have 2 home builder clients here at the firm currently.
But it's all, it's published by, the STAR program or things like that, the federal government. So it's easy to see what the eligibility requirements are. Again, any home purchased after 2022. If you did have anything previous to 2023, the credit was 1,000 to 2,000, depending on the requirements met. Anything under the new law from 23 to 32, the credit ranges from 5,000 to 5,000. So it's a more substantial credit, and that's based on the certification achieved and the requirements met, which includes Energy Star program requirements, Zero Energy Ready Home program requirements, prevailing wage requirements. I'm not going to go through how to claim the credits as we're out of time.
Wonderful.
But we sincerely want to thank you for joining us with this webinar.
Thank you, everybody. Appreciate your time. Please reach out if you have any questions, and hopefully we'll see you November 6th at our tax and financial planning conference.
And again, you will be provided with a copy of our presentation and webinar as well. So feel free to reach out to us.
Thank you.
Thank you.